The Federal Reserve has raised interest rates 11 times in the last 18 months, the fastest rate hikes we've seen in America in the shortest amount of time. Now, mortgage rates have soared to highs the housing market hasn't seen in over 20 years. Now, these high interest rates have really kept a lid on home price appreciation, but what would happen to home prices if the Fed backs off of the rates? Let's play out a few scenarios and take a look at the Housing Affordability Index in America. Welcome back, and if this is your first time watching our channel, I'm Todd Sachs, a real estate broker here in Maryland, serving the real estate industry since 1989. Sachs Realty is dedicated to keeping you informed on everything real estate. So let's go ahead and talk about housing affordability and what could happen in the months to come. According to a recent article on Markets Insider, the Housing Affordability Index hit the lowest level on record this week, according to Goldman Sachs Global Investment Research. In this chart, housing affordability has plummeted since 2020, well below the trough of affordability in 2006, right before the biggest housing market crash post-World War II. Now, what is the Housing Affordability Index? The Fed describes it this way. HAI measures the degree to which a typical family can afford the monthly mortgage payments of a typical home. The value of 100 means that a family with a median income has exactly enough income to qualify for a mortgage on a median-priced home. An index above 100 signifies that a family earning the median income has more than enough income to qualify for a mortgage loan on a median-priced home, assuming a 20% down payment. This index is calculated for fixed mortgages. So wait, 20% down? We'll get back to that. As you can see, we're well below 100 for the first time since the Great Recession. So this calculation is also based on a fixed mortgage rate with 20% down. So let's take a look at the average down payment in the U.S. to see how this HAI index may be adjusted if buyers didn't have 20% down. Oh my! According to the National Association of Realtors 2022 Homebuyers Trends Report, published this June in a Bankrate.com article, only 57-year-olds or older had a median down payment of 20% or more. Actually, the average down payment of a home buyer in 2022 was 14%. So why in the world is the Housing Affordability Index based on a 20% down payment? I guess at a glance, most people won't read the important factors in what's being said. Now, in the first quarter of this year, the average down payment seems to have even dropped a percentage point to 13%, according to an article on Realtor.com. This article is titled "Down Payments Fall from a Recent Peak." Oh man, guys, I'm afraid this Housing Affordability Index would be worse than what was reported if the correct down payment metrics were actually used. So where would this chart be if the average down payment was changed from 20% to 13%? 40? So what's the Fed going to do now that we've already let home prices jump faster than ever before by artificially stimulating the prices due to the lowest interest rates in history? Let us look at the correlation of what happened to home prices when the average fixed rate mortgage dropped to, let's say, 2.72% as it did in November of 2020. See how the home prices took off? They skyrocketed. Now that the horse is out of the barn, what do you think will happen next? Well, I believe that there's basically three scenarios. Number one is prices keep going up as inventory stays low, but stagflation keeps buyer demand at bay and more people move in together and turn to rentals. Or maybe the second scenario will be prices fall as more inventory hits the market as people struggle to make ends meet or can't sell their home at current prices with the current mortgage rates. Or maybe the third scenario will be that the Fed drops rates and restarts spending, allowing inflation to take off again. After all, American consumers depend on debt and monthly payments, not the actual price of something like a home. Well, let's go ahead and play out these scenarios. Prices hold and continue to increase. This is certainly the current narrative that real estate investors are hoping for. All right, so check this out. U.S. home builder stocks have defied conventional wisdom about the effects of rising mortgage rates, rallying furiously and attracting an $814 million bet from Warren Buffett's Berkshire Hathaway. Analysts are still bullish too. Guys, look at this chart of this year. Crazy stock performance in a time of some of the worst housing affordability. Are we missing something? Maybe the investors are expecting more single-family rental growth as the housing crisis is showing no end in sight for homeowner affordability. Look at this article on commercialobserver.com on August 11th. Single-family rental space shows strong fundamentals in 2023. Single-family rentals are expected to remain a long-term player in the commercial real estate asset class world. And millennial renters will be the engine that drives the growth. Now, this is according to Doug Ressler, manager of business intelligence for Yardi Matrix. As millennials mature, they will spark the demand for single-family rentals, and you'll see a strong tide of that going forward in the next 3 to 4 years. And by the way, guys, Yardi has been the leader for years in providing critical data to professional property managers of residential rentals. They have a lot of intel. So let's talk about scenario 2. Prices fall as more inventory hits the market, as people struggle to make ends meet or can't actually sell their home at prices they want with current mortgage rates and the high cost of living. Now, what would it take for this to actually happen? Well, as I've said in the past, in my opinion, the jobs market has been the only saving grace for the housing market. That combined with the continued housing assistance programs from the federal government, like the recasting of mortgages from 30 to 40-year mortgages, cash assistance, and additional modifications for defaulting mortgage payers, which is artificially preventing foreclosures. And these bailouts are exactly why we're seeing historically low foreclosure rates. So now let me ask you, what are your honest feelings regarding the economy and jobs? Do you believe that we will see enough of an economic slowdown whereas employers must lay off employees, resulting in a reduction of jobs and salary decline for what jobs are left available? Because many of the home buyers in the last several years were qualified for their mortgage based on their high-paying jobs, and actually they have little money in the bank to sustain a personal financial downturn. And we know from the history books that nothing attacks home values like job losses in specific markets. And we can see this in the Week.com article titled The Rise and Fall of Detroit. This article goes on to say how Detroit filed for Chapter 9 bankruptcy on July 18, 2013, after Detroit's population plummeted 25% by 2011 from the failing auto industry, as Detroit was once known as Motor City. So what's happening so far that could actually affect the housing market supported by large employers? According to Intelligence.com, the following companies announced layoffs this week. CVS Health to cut more than 100 corporate jobs at Scottsdale's office. GM to eliminate 200 engineering positions to reduce complexity. Logistics company Matheson has laid off 335 Atlanta employees. Intel plans layoffs at the Folsom campus for the second time this year. Disney to reach 4,000 layoffs with the second round of cuts. Tyson Foods will close 4 chicken plants nationwide, cutting 3,000 jobs. But look at these other leading companies that have announced layoffs so far this year. BT, 55,000 jobs. UBS, 35,000 jobs. Yellow Freight, 30,000 jobs. Accenture, 19,000 jobs. Amazon, 18,000 jobs. Vodafone, 11,000 jobs. Microsoft, 10,000 jobs. Meta, 10,000 jobs. Guys, the list goes on and on. If you wanted to take the time to Google it yourself, you'll see exactly what I'm talking about. So let me ask you a personal question. How's your discretionary spending now? Have you reduced your spending in the past year? Are you thinking more before spending money on something that's not essential? Going out to eat less, shopping discounts like never before, or holding off on major purchases like a new car or house? Or finally, let's talk about scenario 3. The Fed drops rates and restarts the spending engine. As I mentioned earlier, we know that after all, American consumers depend on debt and monthly payments, not the actual price of something like a home. But before we assume that interest rates are going to drop, let's see what our Fed Chairman Jay Powell has to say about the idea.
We'd be comfortable cutting rates when we're comfortable cutting rates, and that won't be this year, I don't think. It would be, many people wrote down rate cuts for next year. I think the median was several for next year. And that's just going to be a judgment that we have to make then, a full year from now. And it'll be about how confident we are that inflation is, in fact, coming down to our 2% goal.
Well, it doesn't look like we're going to see any rate reductions this year. So buckle up, buyers and sellers. Looks like these mortgage rates are here to stay. And I don't ever think we're going back below 5% again. So let me ask you, what do you believe will happen? Will we see home prices come down as the economy and job growth slows and more inventory hits the market due to sellers dumping their second homes, their Airbnbs and rentals that they're actually losing money on due to higher operating costs like jacked up property taxes, repair costs, and surging insurance rates? Or do you believe that things are just great like they are and prices will never come down as affordability is wonderful and inventory will stay low with lines of buyers continuing to pay top dollar for homes with no inspections and bidding wars? If you're a home buyer or seller, I'd love to hear from you on this one. Please drop your comments below. And thanks so much for watching this video. If you liked it, you could hit the thumbs up. It'll let me know that you did. And if you haven't subscribed yet, you can do so now. Hit that alert bell. You'll know every time we upload content. And one of the things that you could help me do more than anything else is get this out to more people, because obviously mainstream media doesn't want to cover these facts. So the share button's below. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.